Hello everybody, I am Thamizharasu, your business coach. Today we will dive into a key concept that plays a crucial role in corporate finance, the weighted average cost of capital, also known as WACC. It affects critical decisions from investment choices to asset pricing and key measure of a company's financial health. So without further ado, let's get understand WACC in detailed manner.
1. Understanding the concept of weighted average cost of capital. WACC combines the cost of equity and debt to give an average cost of capital to a firm. It is the rate that a company is expected to pay on average to finance its assets. Now, why is it weighted? Because the cost of each component of capital is given a weight relative to its proportion in the firm's capital structure. It's a bit like how in a recipe you have different ingredients each contributing to the final taste depending on their proportions. 2. The significance of weighted average cost of capital in business finance. WACC is crucial in business finance as it is used by companies to make important decisions about whether to pursue a particular investment. The lower the WACC, the cheaper it is for the company to fund new projects. It means the company is more likely to generate a higher return on projects, making it more attractive to investors. 3. Breaking down the components of weighted average cost of capital. WACC consists of several elements. First, we have the cost of equity, which is the return required by equity investors. Then, there's the cost of debt, the interest expense a company pays on its debt. Both these costs are weighted by their respective proportions in the company's capital structure. 4. The methodology behind calculating the weighted average cost of capital. Calculating WACC involves determining the proportion of debt and equity in the firm's capital structure, estimating the cost of debt and equity, and then taking a weighted average. This might sound a bit complex, but trust me, with time and practice, it becomes second nature. 5. Weighted average cost of capital, a key tool in investment decision making. WACC is a critical tool in investment decisions as it is used in capital budgeting to determine if an investment is worthwhile. If the projected return on an investment is greater than the WACC, it is generally considered a good investment. 6. How weighted average cost of capital impacts corporate strategies. WACC can significantly influence a company's strategies. For instance, a high WACC might push a company towards more aggressive growth strategies to generate sufficient returns. Conversely, a low WACC might allow a company to pursue slower, more steady growth strategies. 7. Leveraging weighted average cost of capital for optimal asset pricing. WACC is also used in asset pricing. It helps in determining the appropriate price for assets, considering both the expected return and the risk associated with the asset. 8. The role of weighted average cost of capital in evaluating company performance. Lastly, WACC also helps in evaluating a company's performance. A decreasing WACC over time can indicate improving financial health, while an increasing WACC might be a red flag for potential financial problems. So, that's the weighted average cost of capital for you. A seemingly complex concept, but once you break it down, it becomes clear how integral it is to financial planning and strategy. If you enjoyed this video and learned something new, don't forget to subscribe to our channel for more insightful business content.